All right, any questions before we get going?
Are we going to cover chapter 11?
Yes, we'll do that later. And that may even end up being next week. So next week will be a lot of review and preparation for the exam. Okay? But I want to cover some material so that we have the opportunity to, you have the opportunity to work on it and ask questions before the exam. Okay? All right, any other questions? All right, so chapter 13, yes? 13. Chapter 13, we're going to kind of pull everything together that we've done. Chapter 13 is the equivalent of chapter 6, where we're creating the financial statements, the income statement, statement of owner's equity, and the balance sheet. And there's more detail to it because we now have cost of goods sold. Help me out here. What are the elements of cost of goods sold? We've been putting this together for the last several weeks, right? So the first thing that we have is purchases. We go out and we buy some stuff. And we bring it in because we're going to put it on a store shelf and we're going to try and sell it. So let's say we went and bought $1,000 worth of stuff. What? Okay. Sometimes you have to pay to get it to you, so you have freight. In, let's say we paid $100 in freight to get it to us. And then we subtotal here and we get delivered cost of, I'm going to abbreviate purchases. Okay? I'm actually going to put it out in a separate column. I'm going to start to make it look like an income statement, okay? So we've got this delivered cost of purchases. What were the other things that we talked about that happen along with this inventory and the merchandise that we buy? Sometimes the stuff's no good and we have to return it, right? So we've got a returns and allowances. Let's say that that's $50. And sometimes if we buy in bulk, we get a discount. Okay? And let's say the discounts we got were $50. Good? That totals $100. It doesn't go there. And what's that called? What? No, I don't think there's a specific line for this, right? I'm just going to give it a name here. Total returns and discounts. That gives us our net, and this is where the book goes, delivered cost of purchases. So what's our net delivered cost of purchases? It's $1,000 because our returns and allowances offset the freight in. Okay? Everybody's good here. We've gotten this far. Okay. What's missing from this? Does this give us our cost of goods sold? Whatever sales we had in this month, was the cost of those sales $1,000? Right. We had some stuff at the beginning. I need a new marker. We had some stuff at the beginning that was already sitting on the store shelves. So we're missing something called beginning inventory. Let's say we had, I'm going to move this out here. Let's say we had $500 worth of stuff sitting on the store shelves at the beginning of the month. And we brought in this net delivered cost of purchases of $1,000. So what I had at the beginning plus what I brought in gives me everything that I could possibly have sold, right? And I'm going to just call that total goods available. Total goods available for sale. And that number is $1,500 in this example. So if I sold everything, the stuff I had at the beginning plus all the stuff I brought in, I paid $1,500 for all that stuff. Okay? But did I sell everything? Was there still stuff left on the store shelves at the end of the month? Probably, right? You ever walked into a store where the shelves were completely bare? Short of knowing that there's a hurricane coming and living in Florida, that really doesn't happen, right? So at the end, we've got ending inventory. I'm abbreviating inventory INV. How much inventory did we have left at the end? Throw a number at me. What? $300. We had $300 left at the end. If I subtract my ending inventory from my goods that were available, everything that I could have sold, what do I get? Cost of goods sold. Now I want to stop there and think this through for a second. We had some stuff, $500 worth. We bought some, we paid some freight, we got some discounts. My cost to get the stuff in my store and on the shelves was $1,000. Add that $1,000 to what I already had, I could have sold $1,500 worth of stuff at my cost, right? I would have sold it for more because I want to make a profit, but my cost of everything that I could have sold was $1,500. I had $300 of worth of stuff still sitting on the shelves at the end. So if I only had $300 worth of stuff still here, where'd the other stuff go? It must have been sold.
Or walked out the door.
Okay, let's let that go for a minute. In some fashion, it left. So it's part of my cost structure at that point. Okay? If it was stolen or if it was sold. Let's assume it was sold. So I have $300 left. The stuff that was sold cost me $1,200. Good? Let's say I sold all this stuff for, let's expand our income statement briefly. What would go up top here? Net revenue. Let's say we had sales for $2,000, and my cost of goods sold would actually come over into this new column. Revenue, $2,000 less cost of goods sold of $1,200 gives me $800. And what does that $800 represent? Well, that's my first stab at a profit, right? Is it my total profit? No, because I still have my rent and my wages and my utilities and stuff. But this is actually called gross profit. You hear the term gross margin used also. Okay? So you have to make enough gross profit to cover all of your rent and your overhead, your wages and your utilities and insurance, and still leave you a profit at the bottom. So this is how your income statement is now going to be different. There we go. It sat so long it shut off. So questions on that? That's what we're going to cover tonight in a very, that's the 60-second version of what we're going to cover tonight.
I have a question.
Please.
On page 441, where it shows the classified income statement.
Yeah.
I don't really get
Go ahead.
what columns put.
Let me field that as we go through this. Okay? There is no hard and fast rule. I just want to, you want to present it in a way that it is easy to follow and easy for the reader, the user to read. Okay? So notice as I did this, I indented and I brought subtotals out and I brought subtotals out, and I brought subtotals out again. So you can see where I'm totaling this and this to get the next number. 1, 2, 3, 4. 4 is a lot of columns deep, but you kind of end up being at least 3 or 4 deep when you're doing cost of goods sold. And it's just an ease of use for the reader. You want the reader to be able to follow. And because I had the advantage of the whiteboard, notice I did some math and then I erased the totals and moved them out one column as I added more features to my cost of goods sold section. Okay, I think it'll become more apparent as we work through it tonight. Okay, all right. So a classified income statement is a multi-step income statement. Multi-step, let me back up. Our single-step income statement was what we did in chapters 1 through 6, where we had revenue, and then we had expenses. And remember, we'd have maybe, several expenses. So we'd have some sort of revenue number, we'd have some expenses, we'd have a total that we'd bring out over here, and we would have net income. Okay? This is a single-step income statement. So as we've gone through chapters 7 through 13, remember we talked about revenue and then having, on the revenue side, sales returns and allowances, sales discounts, net revenue. All that, notice I use the term net revenue up here. So you've got that expanded section up here that replaces this one line. And then you go from net revenue into your cost of goods sold section. And this would have a header, cost of goods sold. And you'd have this whole section that brought you down to total cost of goods sold and gross profit. And all of that, colors, we need colors. Notice all of that's going to fall, if I compare it to our old single step method, here. All of those things that I just showed you happened before we even hit the expenses, which on a single step was the big part of your income statement. So you got to imagine that your income statement's getting quite a bit longer than it was before. And we'll see that. We'll do some here. Okay, single step is the one we used to do. Revenue minus expenses equals net income. Okay, here we go. Multi-step. We have a header, operating revenue. Even in our more complex income statements back in Chapter 6, we would have revenue, and then we would list one type of fees income or service income, and then a second type of service income. Remember, we had computer repair and printer repair on one, and then you'd add them together and get total revenue. Now we're going a little bit further. Operating revenue, sales returns and allowances. Discounts, if you were allowing a customer some sort of discounts, you'd have less sales discounts. Subtract, you get net sales. So our total sales were $56,000. We had returns of $12,000. We've got net sales of $549,000. Good? Everybody follow that? Really straightforward, I hope. And I'm giving you the teaser here for the next slide. The next thing is that cost of goods sold section. So moving right along. I know, come on. We're going to cover this on our own. Thank you. Okay, cost of goods sold. This slide, it moves right to the top. We've gotten the revenue section out of the way. And we start with that beginning inventory. Here's what we've got at the beginning. And to that, we bought some more stuff. We made some purchases, we brought it in, we get delivered cost of purchases. Notice we have purchase returns and allowances and purchase discounts. I want to point something out here because I've had students get confused in the past. Notice this says purchase returns and allowances and purchase discounts, as opposed to sales returns and allowances and sales discounts. The sales stuff goes up above in the revenue section, and the purchase returns go here in cost of goods sold. Okay, they are different. One you're giving to your customer and one you're getting as a return allowance from your supplier. This one. Okay? So you get net delivered cost of purchases. And if you take what I had in the beginning, plus everything I brought in, you get, here's everything I could have sold. This is what it cost me for everything I could have sold. Subtract what's left at the end, right? This is what I could have sold. This is how much I have left. The difference must have been sold. Is how we're calculating that. And that number becomes your cost of goods sold. Now to kind of answer your question and go down that path, purchases less returns gives you a number. I don't like this format personally, but there's nothing wrong with it. I like to work from in to out, but they work from the middle, back in, and then out. It works. You can follow it and see what they're doing, right? So they take their purchases less the freight in to get delivered cost of purchases, and then they subtotal their returns and discounts to subtract it from delivered cost of purchases to get net cost of purchases. Okay? Notice that they put cost of goods sold way out here by itself. Why is that? The net revenue number is going to be in this column up above. It just doesn't fit on this slide. Okay? Questions? So all we're doing different tonight than what we've done in the past is we've added this beginning and ending number. It's really the only difference. Okay. Yes? Okay. Here it all is squeezed onto one slide. And I'm going to try and go through it without having to stand on a chair. So you've got your operating revenue. They calculate sales less returns, get your net revenue. Walk through the cost of goods sold section that we already did, come up with total cost of goods sold. Net revenue minus cost of goods sold gives you gross profit. Okay? Remember, gross profit has to cover all of your overhead expenses, your wages, your rent, your insurance, and your profit. Your profit is part of this number. And I say that because a lot of accountants are involved in the pricing function at companies. And if you look at this and you don't plan on there being a profit there, you might underprice your stuff. Just a thought. Your boss comes in and goes, hey, how come we're not making any money? Oh, wasn't me. So we've got a gross profit here of $219,000. And from that we move on to, now I don't like this slide, but because it's kind of confusing and I've got to get up on my chair. Nobody yelled jump. What they've done here is they've abbreviated the whole top part, sort of. Sales, returns and allowances, net sales. Then they throw in cost of goods sold, all as one line item. Remember that whole big section, they just put it on one line. Here it is, gave you gross profit of $219,000. So the two slides we've seen before are all crammed into these 5 lines. And then they show you the next thing is the operating expenses. Remember from our single step income statement, you went from revenue to expenses. Here's the expense part of it. And in its most basic format, you would just go through and list the expenses. Typically, it's done one of two ways, alphabetical order or the highest dollar amount expenses at the top and you work your way down to the lowest. Okay? I see that one done more often than the alphabetical. But here's the new twist. It's standard procedure to break out your selling expenses from your other operating expenses, what are called general and administrative expenses. Because a lot of companies like to watch, and it helps them manage their companies, to watch how much it costs them to generate the sales up here. And that's your sales department that does that, right? You've got people that run around and go see customers, put on promotional stuff, do trade shows, all of those selling expenses and advertising is involved in generating those sales. So what does that cost? What does it cost me to generate $1 worth of sales? So you've got to break these out and separate them. So notice we've got the big header of operating expenses and then a subheader of selling expenses. And we're going to list all of our selling expenses, the salespeople's salaries, advertising, supplies. And if the salespeople have vehicles or something, or they're in their own building, they're going to have their own depreciation that goes in the selling expense part of the income statement. Okay? Total selling expenses. Then you get into the rest of the company's expenses, general and administrative, rents, wages for everybody else, insurance expense, depreciation on the other things that are used in the business, bad or uncollectible accounts expense, I call it bad debt expense, utilities, all kinds of stuff. Good? Okay. I'm going to try and make that screen go down further. Nice. I knew I was getting cheated. So you've got operating expense, subheader selling, total selling, subheader general and administrative, total general and administrative expenses. You add your selling and your G&A expenses together and you get total operating expenses. Gross profit minus total operating expenses gives you income from operations. Right? Somebody smile and say yes. Okay. Now, since I'm having one of those moments where I'm trying not to confuse you with my other class, that's your operating income. That's what your profit is from being in the business that you're in. Okay? And what I'm trying to do is separate out other things that are not related to the business that you're in. Okay? If you have, there's something called other income and expenses. We've talked about that, yes? So for example, we buy these vehicles for our salespeople. They go out and they drive them around, they see customers, they get sales, right? They write up sales, and they generate the revenue on the top line. After a couple years, they've put a lot of miles on that vehicle and they want to sell it. We, the company, sell it. When we sell that vehicle, is that part of our revenue? We're not in the business of buying and selling vehicles, right? We're in the business of selling whatever it is we sell here. Widgets, gidgets, whatever they are. What?
Antiques.
Antiques. Oh, we're in the business of selling antiques. So when we sell that vehicle, it doesn't go in revenue with the revenue from selling of antiques. It's going to go down below income from operations as a gain or loss from other than operations. Okay, and if I haven't covered that before, I'm going to go into it in a little bit of detail right now. Yes, ma'am.
Cost of goods sold, where do you get that number from?
That was this great big calculation that we did over here. And remember I was telling you that they shrunk it all down to one line. Cost of goods sold is your beginning inventory plus the stuff you bought into the company, including the freight, less returns and allowances, less the inventory that was left at the end. And that's your cost of all the things that went out the door as part of your sales process. And then on this next slide, they cheat us because they shrink it all down to one line and they plug it in there. Makes it look like it goes away, but you really need to present it in its full-blown glory like we've done here. Okay? Other questions?
Will this be on the exam?
Absolutely. I think maybe you might see it again. Yes, ma'am.
So we've already done the piece that's in the slide before this one. Do we have to restate the operating revenue again?
No. See, and that's a great question, because I'm making an assumption here that you see what's going on. They're breaking this down into these different chunks because it doesn't fit on one slide. When you do it in the real world or on an exam, it's going to be one piece of paper down the whole page, and they're all going to show up on one page. And I believe there's a slide here in a few minutes where they're going to show the whole thing, but it's going to be real small and it's hard to read. So I'm kind of building all the pieces together and showing you how we're building it, and then I'll show you the finished project. Okay? Other questions? Okay. So this is how we get to income from operations. This is the profit or loss we made from being in the business that we're in. Next slide. Thank you. On the next slide would be the piece that went below what we were just looking at. So we're starting with that income from operations, that $51,000. We lent somebody some money, so we've got some interest income. Are we in the business of lending money? No. We sell antiques, right? So that's non-operating revenue. Miscellaneous income. What? Yeah, I hate miscellaneous because what is it? I don't know. We sold an old computer that belonged to somebody and they paid us $582 for it, right? It was a fixed asset. We're not in the business of selling computers. In the world of computers, it might be an antique, but it's not the business we're in, so. Okay? So we've got miscellaneous income of $582. Total other income, $784. Notice it's defined as other income because it's not operating income. Then we've got other expenses. By definition, we went out and borrowed some money and we paid interest on it, interest expense. By definition, interest expense is always an other income or expense item. Write that down, remember that. It doesn't go up above in your operating expenses. It's always an other income or expense item. Even though it may be normal for us to borrow money all the time, that's not the business we're in. We're not in the business of borrowing money. Okay? So it goes down below in other. So if I take my other income and I subtract my other expenses, I get net operating expense, because my expenses are bigger than my other income. So I've got an other expense of $22 in this example. Okay? Again, with the abbreviated income statement, net income from operations, here's that $51,000. You plug in the other income, other expenses. Notice other income, other expenses, $22 of other expense, $51,193 minus 22. Now my net income is $51,171. Okay? That's the whole income statement, end to end. Everything that could be there. Okay? As far as this class is concerned. When you get to 1A, we'll cover a few other things. Questions? Answers? They're not going to show me the whole thing, even though if it was real small. I know if you look in the book, there's an example of the entire income statement all on one page. Everybody's just looking at me. Nobody wants to ask questions? No? Okay, somebody shook their head no. On we go. Now, here's the bonus of Chapter 13. Remember, there's three financial statements. Income statement. Second one is the statement of owner's equity. So the income statement got a lot bigger, right? The statement of owner's equity doesn't change at all. Nice, yes. It's just like it was before. Make the red circle go away. Bring the numbers back. Can't have both. So again, who, what, and when. Always a header on your financial statements. beginning capital, plus net income, less withdrawals, total increase in capital, ending capital. Nothing has changed from chapters 4, 5, 6. Okay, nothing new to learn here. Moving on, unless you want to ask a question about it.
So I just have a question.
Yes.
Sorry, for the test or the thing. So we're going to do anything about the income statement on the final. Are you going to like have all the fields there and we just fill in the numbers?
No. What I want you to do is go find the full-on income statement in the book, copy the page, fold it in half, put it under your pillow. Sleep with it. Learn it, live it, love it, because you will see it again and you'll have to recreate it. And I'm sorry to say you're going to recreate it from scratch. Okay? We've spent 16 weeks building to this. You know most of it. The only thing we've added is the beginning and ending inventory, really. So I know you're capable of doing it. And you just did it on mini project number 2. So you've had practice with it even. Okay? All right, balance sheet. Does our balance sheet change? A classified balance sheet does change a little bit. Have we talked about current and non-current prior to tonight? No? Okay. Here we go. Remember our chart of accounts is in assets equals liabilities plus owner's equity order? And our balance sheet is assets equals liabilities plus owner's equity. And it proves that you're in balance there, right? That's what the balance sheet is for. We want to be able to analyze this in a little bit more detail. So we're going to break out our assets and our liabilities into current and non-current. Anybody want to take a stab at what current is? Current assets. Remember, we're focusing on the accounting cycle in this class. So the accounting cycle typically is, like a year long, right? So by definition, the standard convention is current assets are anything that are cash or cash equivalents or will be turned into cash within a year. So when you're defining current or trying to figure out what's current, the gold standard is cash. So here's the example, and I'm going to go through it as an example. In assets, by definition, cash is current because the gold standard, right? So we've added this new subheader, current assets, and we list cash. What's the next thing that will be turned into cash in our assets? Typically, it's accounts receivable, right? Because we've given customers 30 days to pay, even though we know some of them won't pay. This is the first thing that's going to turn back into cash.
Yes, notes receivable up there.
All right. God, they have to go and make it hard. All right? Make it difficult. I'm still telling my story. Accounts receivable typically turns into cash in 30 days, right? So it would be the next thing to turn into cash. So you would list it second. So in this case, I have cash. I have multiple bank accounts. I have a petty cash fund. Is that cash? Yes. So it gets listed up here right next to cash. Accounts receivable would be next. And all of a sudden, because you list these things in order, inventory is going to fall in here somewhere. Inventory will eventually turn into cash, so it's further down the page. Now here's the twist, and here's what they've done to us to make it tough tonight. The balance sheet, because we have this hierarchy of current with cash as the gold standard, can now tell us a story. And this one is telling me a story. I have cash, I have notes receivable before I have accounts receivable. This tells me that my note receivable is going to turn into cash sooner than 30 days. Because it's listed above accounts receivable. Because of the order I put it in, I'm telling the reader, this is going to turn into cash in less than 30 days, or sooner than the accounts receivable will. So this must have been, let's say it was a 6-month note that This is December 31. That 6-month note is going to get paid off January 10th, 2011. So in 10 days, that's going to become cash, which is less than 30. So therefore, it gets put in above accounts receivable. And that's the only reason it would go there. You don't just put them in willy-nilly order. There's a reason it's where it is.
And if it was longer than a year, it wouldn't even go on the page to begin with.
If this notes receivable was going to get paid off 18 months from now, it would not be in current. It would be in non-current down below, other assets. So I know by where it's placed that it's going to get paid off in less than 30 days. Then I have accounts receivable. I want to just highlight the presentation here because we talked about that allowance for doubtful accounts in chapter 12, right? So we've got accounts receivable, less allowance for doubtful accounts. Look at the presentation. My accounts receivable is 32, my allowance is 10.5, and I carry my net realizable balance out over here in the column where I'm going to total. You guys see the presentation? Okay. Very important. Interest receivable, I'm going to get that sometime in more than 30 days. I'm using accounts receivable as a judge here. Inventory is going to turn into cash sometime more than 30 days. Prepaid expenses. Think about this for a second. We prepaid our rent, we prepaid some supplies, we prepaid some interest and some insurance. Why is that listed at the bottom? We could go and ask for a refund for that, right? And we could get a check from the guys tomorrow, maybe the next day. Shouldn't that go higher up because I could turn it into cash sooner? It was never our intent to turn it back into cash. It's our intent to use it. That's why we prepaid it. So as a result, I'm not going to treat this like it's going to convert back into cash quickly. I'm going to treat it like it's going to turn back into cash the longest or the slowest of any of the things. So your prepaid stuff goes at the bottom of your current assets. Okay? Questions on that? Everybody good with the format? Okay. So in the same vein that we have current assets, we come down to total current assets. We then go on to the next section, property, plant, and equipment. Again, with the trying to cram stuff onto one slide. Here's total current assets from the previous page. Now we have this new section, property, plant, and equipment. This is your trucks, your land, your buildings, the equipment you use, the office furniture, the computers. All of that gets listed with its accumulated depreciation. So notice, store equipment, less accumulated depreciation. Office equipment, less accumulated depreciation. So store equipment, less depreciation. This is your book value, right? Office equipment, less accumulated depreciation, book value. You add those two together and you get total plant and equipment, total property, plant, and equipment. Everybody see the presentation there? Are we good with this? Now the book goes and takes your current assets, adds property, plant, and equipment, and gives you total assets, which is fine. That may be the truth. But Ron had an example a minute ago where we have a long-term note that we're going to receive in 18 months. Where would that go? After property, plant, and equipment, we would have another section called other assets, things that are not going to turn into cash within 12 months, and it would go here. And you would total all three sections to get total assets. Fair enough? Yes, ma'am.
So on the previous, are you adding all of those or you're subtracting the expenses?
There's no expenses here. You're on the balance sheet.
Okay.
Okay?
So we're adding.
So I have cash, asset, cash, notes receivable, accounts receivable, less allowance for doubtful accounts. So I'm actually subtracting here, but everything over here is being added down. Okay? And actually prepaid expenses, I list them out, and all of those get added up to get that number. Okay? Here on the next page, equipment less accumulated depreciation gives me the book value. Equipment less accumulated depreciation. And then I add those together and I add everything out here. Okay? Make sure you do your homework because we'll go over it next time and you'll get more practice with it. So just like we break our assets down into current and non-current, we're going to do the same thing with the liabilities. So with current assets, remember cash was the gold standard. What do you think the benchmark is for liabilities?
Accounts payable.
Close. How soon I'm going to have to use my cash to pay it off. So it's still, the benchmark is still cash. When do I have to use my cash to pay for it? So liabilities and owner's equity, I have current liabilities. In my world, almost always accounts payable comes first, right? Because I have to pay that in 30 days. But here I've got two notes payable. What am I saying by putting them above accounts payable? I have to pay for them in less than 30 days, so I need cash right now to pay it. Okay? Then I have accounts payable, then I have my payroll taxes payable, because those you typically have to pay pretty darn quick. Salaries payable, I have to pay that. What I'm saying is I have to pay that longer than accounts payable, longer than 30 days? That sounds fishy. And sales tax payable. And add all those up, you get total current liabilities. Why do we break out current liabilities? Current assets is so we can track how much cash we're going to get, right? And when. Current liabilities you separate from your longer term liabilities, because if you're running this business, you need to know how much cash you are going to have to come up with soon. And this tells you. It helps you run the business. So I can look at this and go, well, I better have about $46,000 in cash sitting around somewhere. I'm in trouble, right? Because if you don't have cash, you have a nightmare. You're out of business, yes? So in this case, we had, remember we had current assets of $98,000 and we have current liabilities of $45,000. We look like we're in pretty good shape, right? Yeah, what?
2 to 1.
Yeah. So this helps me run the company. I think I can turn most of my assets, or those current assets, into cash, about 98 grand worth, and I'm going to have to come up with about 46 here in the next month. So I think I'm okay. It helps you run the company. Questions on current liabilities? So you go from current liabilities, there is no property, plant, and equipment. We got cheated. There's no liabilities. There's no property, plant, and equipment that goes in liabilities. So what you do is you skip that and you go from total current liabilities to other liabilities or long-term liabilities. And you list things like long-term note payables, mortgages, things that you're going to have to pay off in more than a year, more than that 12-month period. Okay? And you just list them and show total long-term liabilities, and you add your current liabilities and your long-term liabilities, and you get total liabilities. Good? Okay. Then you come down to the next section. What's the last section of the balance sheet? Owner's equity. Somebody can do it. Owner's equity is just the capital account, as you recall. And the capital account you pull straight from the statement of owner's equity that you prepared as the second financial statement. And if you don't pull the balance from the statement of owner's equity, you've omitted the net income and the draws, and you'll be out of balance. Right? Everybody remembers that? That second test, did anybody when they did their balance sheet end up out of balance? Some of you did, and it's because you pulled the owner's equity right off the trial balance and not off of the statement of owner's equity. Okay? So this is your chance to redeem yourself. Questions? Who wants to go home?
The camera does it. It has that last triangle.
Okay. Anybody else? Nobody? Good. We'll stay then. So I want to walk through the accounting cycle again. You guys remember the accounting cycle? We get transactions, we analyze them, we put them in the appropriate journals, we book them to the general ledger, we create the worksheet, do the adjustments. From the adjusted trial balance, we do financial statements, which is what we just did. After you do the financial statements, remember those adjustments that we put on the worksheet, they're not recorded in our permanent records in the general ledger. So we have to go and post those adjustments to the general ledger. So I want you to remember, go post those to the general ledger. Okay? You can do them on one page in the general journal and put adjusting entries at the top and just do them, right? We did that on test number 2. We did it on mini project 1 and 2. So you record those in the general journal and then post them to the general ledger. And after you've posted the adjustments, what's the next step? You said it. Say it louder. Closing. So we do the closing entry. And everyone remembers the closing entry from chapter 6, yes? There are how many steps in closing? Come on. How many steps? There are 4 steps. Okay, there's 4 steps. 1, you close the revenue accounts. So you zero out the revenue accounts and post them to income summary. Step 2, you close the expense accounts and post them to income summary. Step 3, you close the income summary and post it to capital. Step 4, you close, draw, post it to capital, right? Okay, so there's 4 steps. Those 4 steps still exist. There's one more now. I say there's one more. We have something new. We have now calculated ending inventory. And have we made an adjustment for it? Yes, we're going to make an adjustment for it on our books. Okay, good. Can you stop for a sec?